What's good, everybody? And welcome back to another episode of the Trade for Yourself podcast, where my mission here is very simple. I just want to help you learn how to trade for yourself. Please like, please subscribe. Make sure you hit that notification bell so you can be in the know every time I drop a piece of content. Also, please note, this is not financial advice. So please do your own research before investing into any stock. This episode, we're going to do a market update, and we're going to do an update of what the stock market has been doing over the last quarter of this year. This last quarter that we just went through was the worst quarter for stocks in the last 2 years. And I know a lot of portfolios have been beaten up. My portfolio has been beaten up just like everybody else's. But this is an opportunity for us to do a review, to go back and look over what happened, evaluate it, think about what it means, and we also have to decide how are we going to prepare moving forward for the remainder of this year and beyond. Let's get right into it. So let's start this off by looking at a chart of the S&P 500, because the chart is really going to tell us about the sentiment of the market, meaning how people feel about the market. So this is a year-to-date chart of the S&P 500, measuring where we were on January 3rd up until now. So we hit our all-time high on January 4th with a level of 4,818.62, and our year-to-date low is 4,114.65. So I'm using TradingView to make this chart, and the reason why I like TradingView is because it gives me the ability to use a tool called info lines, and I can draw lines and it can tell me the percentage either up or down that a stock or an index has moved, and it can also give me like the time frame behind it. So most people know that we went into the correction during this time, and we went down 14.6%. Like, that is a big deal for the S&P 500. And it took us 51 days to go from the 52-week high all the way down to the year-to-date low. Now, this year-to-date low happened on February 24th, and that was when Russia commenced to invading Ukraine. And so that's really a data point that we need to mark and that we need to watch. Now, if we keep moving forward on the chart, one date that I really want us to notice is March 14th. March 14th, we were at the level of 4,161.72. And in technical analysis terms, we created a double bottom at this level. So we like to mark certain levels to kind of tell us, okay, is the stock or is the index going below this level or going above this level, as a check for how the market really feels and how we should trade it from a technical perspective. So if we look at where we were on March 14th all the way till we go to March 29th, I have an info line drawn. Over that 15-day time span, we went up over 11% in that 15-day time span. And so the one thing that I really need us to understand by looking at these info lines and looking at this chart, when you're getting into the market, everything is about entry points. You never want to buy the market at the high. You always want to buy when things are on a discount. You want to buy when things are lower to give yourself some breathing room. This will give you an opportunity to get in at a better price. So the people that bought at the high, they are probably screaming and crying right now because we came all the way down to that level. I have to quote Ian Dunlap right here when he said that there's no such thing as a bad market, only bad entries into it. You don't need to be emotional about this. A lot of people get emotional about trading and investing. It's really about your entry points. So really what I need you to understand is that if you would have bought on March 14th at the level of 4,161.72, you would have gotten an 11% return in a 15-day time span. Now, the market can move very, very quickly. Am I sitting up here trying to guarantee you that you can get certain returns? No. But if you learn technical analysis and you learn how the market actually moves, then you can really be a precise trader and a very good investor. So I talked about the first info line that I drew that lasted 51 days, talked about the second info line that I drew that lasted 15 days. Let's talk about the third info line that I drew that lasted 91 days. So from the beginning of this year all the way to the end of the quarter, the S&P was down only 6%. So we've had a lot of volatility, y'all. We've had a lot of volatility, a lot of up and downs, a lot of economic data, a lot of geopolitical risk, a lot of companies reporting corporate earnings and things like that. But even with all of that being said, we're only down 6%, and now we're out of correction territory officially. Now what we have to look at is we have to review what has happened over the last quarter from a technical standpoint, and now we have to marry the technicals with the fundamentals. We understand what has happened, but what can we expect to happen in the future? The next indicator I want us to look at is the Fear and Greed Index. Now, this index was created by CNN Business, and this index is a measure of the sentiment of the market. How do people feel about the market? What emotion is driving the market? Now, I like to look at this indicator to see when I should buy and when I should sell certain stocks, certain assets. So to your right, so let's just look at where are we at right now. As of right now, we're at about 46 on the Fear and Greed Index. And the Fear and Greed Index is a measure from 0 to 100. So at 46, we're in neutral. So we're in neutral. We're almost 50-50. We could go either way. We could go up or we could go down. Now let's measure where were we on the Fear and Greed Index over a period of time. So the previous close, we were at 48. A week ago, we were at 53. 1 month ago, we were in extreme fear. We were at 21. We were actually below 21. We were actually hovering around 14 and 15. Now, if we're at 14 and 15 on the Fear and Greed Index, it's almost, I'm not a financial advisor, y'all, but you have to buy there because there's so much pessimism. There's so many people talking about like how the market is just so bad, so much negativity. When you come down to 15, you gotta buy there. And then 1 year ago around this time, we were at neutral. So this is a good measure of kind of how everything has been going over specific time frames. And I really truly like the Fear and Greed Index because I always think about what Warren Buffett said. When people are fearful, be greedy. And when people are greedy, you need to be fearful. So this is an indicator that I like to use. I would like you all to please do more research on the Fear and Greed Index yourselves to kind of see how you can use it to mirror how you view the investing landscape yourself. So let's discuss what's been going on in the economy. The Federal Reserve finally told us that they will be raising interest rates this year, little by little, and they told us that they will be reducing their balance sheet. So this is a ever evolving process. This settled investors down a little bit because this finally gave us some certainty. Investors were moving and they were behaving very uncertain because they didn't know exactly what the Fed's plans were. But this is still an ever evolving process. The Fed can always change their mind at any given time. So I know people are probably being nauseated about what's going on, but look, this issue is not going away anytime soon because inflation is here, and a lot of people believe that inflation is here to stay. So the Fed is always going to be a topic of conversation, so we have to really truly do our research and be diligent as investors, really truly understand what the Federal Reserve's purpose is so we can move forward properly. Now, we've also had to deal with some geopolitical risks with Russia invading Ukraine and the price of oil going up. Now, the United States government and the EU, European Union, and other governments have been trying to curb this issue and pretty much put sanctions on Russia for doing what they're doing over there in Ukraine. The market is just digesting this. They're still trying to digest this, and the market has also settled down from that. Remember when I told you from the chart, we had that year-to-date low on February 24th because of Russia invading Ukraine. This is still an ongoing situation. We don't necessarily know what the finality is going to be with this conflict, but we've got to keep an eye on it just to see what's going on over there. Another major thing that happened this quarter was that the yield curve inverted. Now, the yield curve is a key economic data point that economists and investors use to measure the health of the economy. Now, what is the yield curve? The yield curve is simply a measure of short-term interest rates and long-term interest rates of bonds. So, what are bonds? So, a bond is pretty much me loaning out some money to an institution for an expected rate of return, an expected payout that I'll get every single year, and then I'll get my money back at the end of the term. Now, from a risk standpoint, it's more risky to loan out money for longer terms of time than shorter terms of time. So pretty much the interest rates for a 10-year bond are typically higher than the interest rates for a 2-year bond because it's longer time, more risk. Then you've got your 2-year, which is shorter time and longer risk. So when the shorter term bonds end up being higher than the longer term bonds, that means that the yield curve inverted. And so what that means is that over the past 50 to 100 years, every time the yield curve has inverted, that has accurately predicted a recession within the next 18 to 24 months. Now, the last time that the yield curve inverted was in 2019, and then we had a recession in 2020 due to COVID-19. But I want to say that that data point right there is a little bit misleading, because the reason why we had an economic recession was because of a global health crisis. It wasn't a normal recession that was due because of borrowing rates and people borrowing too much and just people not having enough money. It was because the global economy shut down and the Federal Reserve had to take certain measures to be able to get the economy back moving, back chugging along. And so what I'm going to tell you is that I don't know if we're going into a recession. But the one thing that I will tell you is that this is a data point that we need to watch and that we need to check. Remember, the Federal Reserve controls interest rates. So they're looking at this just like we're looking at this. The key measure that we want to look at the yield curve, pretty much looking at the 2-year and the 10-year, right? The 2-year and the 10-year is what we need to be looking at in terms of the yield curve. Now, this is going to be my first time as an investor really experiencing the yield curve inverted. So I don't have enough experience in this realm to really truly give you what I think you should do. What I think you should do is just protect yourself at all times. And please do your research on what the yield curve is and what an inverted yield curve actually means. Now, like I said, we've had data points over the last 50 to 100 years that have showed us that we are going into a recession, but at the same time, we still need the data to validate it. We can't just assume it, but we need to protect ourselves at all times, and we need to diversify our portfolio into different asset classes so we can be protected on all sides. So I've talked about the events that have occurred over the previous quarter. So what kind of outlook can we look at for the remaining of the quarters for 2022? The one thing that I will tell you is that how we perform in the stock market this year will be directly related to the economy. So we have to tap in and we have to really become students of the economy. We have to watch what GDP is doing. We have to see if the economy is increasing or if it's decreasing. We have to watch inflation, specifically inflation in terms of commodities, specifically related to agriculture, because we've got the price of food and goods really going up in the grocery stores. And so that could really truly reduce the amount of purchasing power that people have in the economy. So we've got to watch that type of stuff. We've got to watch the price of oil. We have to watch the Federal Reserve, and we have to watch what they are going to do with interest rates. And the one last key economic thing that we have to look at our corporate earnings for our publicly traded companies. This quarter is going to be a very, very key indicator because of everything that we've had to go through in Q1. If the big companies, if our big billion-dollar and trillion-dollar companies are able to produce and over-deliver on earnings in the quarter that we just went through, I feel really, really good about how we can perform for the rest of this year. If not, buckle up your seatbelts. It's going to be a bumpy ride, and it still may be a bumpy ride nonetheless. But this is what we love as investors. This is what we love, y'all. We love being able to really sit down and really have these higher level conversations in terms of looking at the economy and the stock market. As always, I thank y'all for listening to this episode. I'm just so glad that y'all are tapping in with the Trade for Yourself podcast. Please like, please subscribe, please hit that notification bell so you can be in the know every time you drop this episode. Now, full disclosure, if you need a shoulder to cry on, if you are emotional about your portfolio, hit me up. Reach out to me. I can help you look at this from a different perspective. Everybody's portfolio has been beaten up, mine included. But I can help you look at this from a different perspective and understand that this is only a part of the game. As always, don't pay for it. Trade for it. I'm gonna catch y'all on the next one.